to read a statement from the Federal Reserve and ultimately have a press conference from Chairman Powell, Joe. Mm-hmm. And there's a real possibility that despite what we heard just weeks ago after a hot CPI report from President Biden, who said there will be rate cuts this year, that the chairman could indicate, in fact, there very well may not be.
Yeah. Or could there be a hike this year still to come? I think there are 30% odds on that at the moment as we wait to hear from what we're told will be a much more hawkish Jay Powell. He's got a point to prove today, Kaylee, and it's based on the data. It's very hard to deny what's happening here in this economy, and it's something we wanted to spend some time with Lindsay Owens to talk about before we turn things over to our special Fed coverage. Lindsay is an economist at the Groundwork Collaborative, where she's executive director. And Lindsay, it's great to have you back. How concerned are you, knowing your background in economics here? You have a slightly more progressive view, and the idea of a more hawkish Fed at this stage, when you consider the impact that these rates have had higher for longer on the housing market, creating a higher barrier for entry for young people, more potential risk for the job market. What are we about to hear?
Yeah, absolutely. I mean, I think it's pretty clear that Powell is unlikely to veer off his higher for longer strategy, holding rates steady for now, but potentially coming off some of the earlier projections for September rate hikes. But, the question I think we have to ask ourselves here is, what are the benefits of a higher for longer strategy and what are the risks? And I do think, given the areas where we're seeing sticky inflation, it's really unclear that the higher for longer strategy has a lot of payoff. When it comes to the housing market, when it comes to energy costs, when it comes to auto insurance, which is another one of the areas where we're seeing more inflation than we'd like, none of those are really responsive to the Fed's interest rate policy. And in fact, when it comes to the housing market, it may well be the case that the Federal Reserve's policies are exacerbating some of the pricing that we're seeing in the housing market. So I think the evidence that the higher for longer strategy is going to sort of bring down the last mile of inflation is thin. And I think the evidence that the higher for longer strategy is starting to post some considerable costs is getting stronger by the day.
Okay, Lindsay, your point is well taken that a lot of the stickiness is where you see most directly interest rate policy transmitting, as in higher rates, higher mortgage rates. That has ripple effects throughout the housing market, for example. But isn't the risk of not keeping rates higher for longer, that rates going down or the expectation that they will go down further fuels demand, gets people out there spending, and all of those different areas of the economy where we're not talking about inflation getting sticky suddenly do start to see prices spiking higher again? Isn't that really the concern?
Yeah, absolutely. The Fed is trying to, handle the upside risk of inflation sort of, picking back up considerably, right? They're worried about that. I think we've seen a lot of inflation come down because of transitory factors and also because of supply coming back online. I don't think there's huge risk of, a big increase in consumption here that's going to have inflation sort of unmooring and sort of spiraling out of control. So I'm definitely in the camp of someone who actually thinks coming off interest rate hikes at this point, is smart. I would like to see cuts, frankly, given where we are in the cycle here. But, we'll have to see sort of where Powell is at 2:00. But, at the end of the day, he's signaling that he's going to stick with the higher for longer strategy. And I think, we're all sort of watching this experiment play out in real time of the Fed trying to chase inflation down to 2%, and, hoping that they'll be successful. But increasingly, when we parse the individual data, it really doesn't look like this last mile is going to be responsive to interest rate hikes. And so I think we're in a real predicament here.
Does that last mile last through November? Because we've talked a lot about the political implications of interest rate changes around the election, and Joe Biden's got his eyes on about 6 months from now. Where are we in the cycle then, Lindsay?
Yeah, I mean, you're absolutely right. The political consequences of this really punishing interest rate environment are considerable. Americans' top concern about the economy right now is high prices, but they're also concerned about high borrowing costs. They're concerned about mortgage rates, which are incredibly high right now. I mean, look, I think sometimes we get focused on sort of watching mortgage rates tick up and down. But, let's think about what this means in real terms for families. I mean, I myself would be paying twice as much per month in today's interest rate environment than in the interest rate environment in which I bought my home. That is a considerable difference, right? Twice the monthly mortgage payment, right? So this is pushing folks out of home ownership for years, right? Folks not being able to jump in to the mortgage market. So the effects of this are considerable on the economy. Of course, the economy is top of mind as folks head to the ballot box in November. And we also have to look at some of the other things that are influenced by the high interest rate environment. I mean, Americans are holding a huge amount of debt right now. APRs on credit cards are sky high, and credit card companies are really in some ways hiding behind high federal fund rates to keep APRs really higher than they need to be. So I think this is affecting consumers, most consumers, many consumers in America every day, the high cost of borrowing. And it's absolutely the case that getting some relief on borrowing, I think would be really helpful for President Biden before November.
Lindsay, we have just about a minute left before we hand things over to our special coverage in about an hour until Chairman Powell walks up to that podium to deliver the press conference. If you had one question to ask him today, what would it be?
I mean, look, the question I have is, are we really getting payoff from higher for longer? What is your evidence that higher for longer is going to get that last mile of inflation down, that is going to get housing costs down, that is going to get energy costs down, that is going to get auto insurance premiums down? I think you've really got to ask yourself, sort of, is the juice worth the squeeze here in the high interest rate environment? And then if I got a follow-up question, I would sort of be interested in hearing him articulate the consequences of higher for longer, because I would hope he's well aware of the consequences here for American families.
All right, Lindsay Owens, Groundwork Collaborative Executive Director, former Senior Economic Policy Advisor to Senator Elizabeth Warren. Thank you so much for joining us. It's an excellent question, Joe, about the way that monetary policy is transmitting in this economy, whether we can actually get down from 3% to 2%, or maybe the question Chairman Powell would like to answer least of all, is 2% still achievable?